Hey everyone, welcome to Financial Accounting and Reporting. So we are now in Chapter 3, and Chapter 3 is all about Statement of Financial Position or Balance Sheet. And we are still using the book of Financial Accounting and Reporting by Mr. Nick L. Aduana. Statement of financial position is a structured financial statement that shows the assets, liabilities, and equity of a business entity as of a given date. So it's a structured financial statement because it follows a specific format on how to present the three accounting elements, which are the assets, liabilities, and equity. And then take note with the phrase as of a given date. So if you notice, if we're going to prepare a statement of financial position or balance sheet, it is always dated as of. So like for example, we have statement of financial position as of December 31, 2021. Okay, so if that would be the date of the statement of financial position, which is dated as of December 31, 2021, that means that the information or the data in the face of the statement of financial position is true and correct only as of December 31, 2021. You might be asking why, in the example, the statement of financial position or the balance sheet dated as of December 31, 2021 is true and correct only as of the said date. So here's the reason to that. So almost every day, the business has transactions, and these transactions will eventually affect the accounting elements. It will affect the assets, the liabilities, and the equity. And with that being said, the information on the face of the statement of financial position as of December 31, 2021 will no longer be the same a few days after or few weeks after or months after December 31, 2021. So, nananay yung mga changes. As I mentioned earlier, the statement of financial position or the balance sheet will give us the information regarding the assets, the liabilities, and the equity of a business entity. When we say assets, these are the resources that are owned and controlled by the business entity. In Tagalog, we say lahat ng pagmamay-ari ng business ay tinatawag nating assets. Now for liabilities. So liabilities are the obligations of the business entity that requires settlement in the future. So lahat ng utang ng business ay tinatawag natin na liabilities. And then we have equity. So this is the residual interest of the assets after deducting the liabilities. So assets minus liabilities is equal to equity. Okay, so otherwise stated, lahat ng pagmamay-ari or lahat ng assets ng business ay nakukuha yan in two ways, and that are from utang, which we call liabilities, and from the capital of the business owner, which we call owner's equity. As I mentioned earlier, equity is the residual interest. So kung gusto mong malaman kung magkano ang owner's equity, ang gagawin mo lang is i-deduct mo yung lahat ng utang o kaya liabilities ng business mula sa total assets. Thus, total assets less or minus total liabilities will give you the owner's equity. Now let's talk about recognition of assets and liabilities. So the term recognition refers to the process of incorporating or including an item that meets the definition of an element and also satisfies the criteria as set by the framework. The recognition begins with identifying the transactions and events. The transactions and events must be accountable, meaning to say it should affect the accounting elements, it should affect the assets, the liabilities, and owner's equity of the business. Once the transactions and events are identified, they will then be recorded chronologically in the books of accounts. When we say chronologically, that means transactions and events must be recorded in the order of occurrence. So, dapat sunod-sunod siya based on the dates. Dili pwede nga mo record kag January 15 and then followed by January 17 and then followed by February 13 and then January 18. Dapat sunod-sunod sila. So, it must be January 15, January 17, January 18, and February 13. Moving on to the criteria for recognition. So, let's start with the assets first. So, assets are recognized if 1. It is probable that future benefit will flow to the entity, and 2nd, the cost can be measured reliably. And then for the liabilities, they are recognized if one, it is probable that future benefit will flow from the entity, and then the cost can be measured reliably. And these are the information that must be presented on the face of the statement of financial position. So I am not gonna read these items one by one. So just post this video so that you'll have the time to read all the items. Okay? Okay, so apart from this information, the face of the statement of financial position must also present the total assets that are classified as held for sale and the assets that are included in disposal groups that are properly classified as held for sale. The face of the statement of financial position will also show the heading. So this heading is written on top of the report and it has three lines. The first line is the name of the business. Second line is the title of the report, which is the statement of financial position. And the third line would be the period covered, and it will start with as of. And then there will be subtotals also, like total current assets, total non-current assets, total current liabilities, total non-current liabilities, total liabilities, like that. And then it also includes additional line items that are relevant to the understanding of the entity's financial position. The assets of the business entity are classified into current and non-current. Current assets are those that are expected to be realized in or is intended for sale or consumed in the entity's normal operating cycle. The normal operating cycle of a business entity normally starts with the cash. So this cash is used to purchase assets which are then processed and eventually sold to customers. Customers are received by the business entity. So it starts with the cash and ends with the cash. So that is the normal operating cycle of a business entity. If the normal operating cycle of a business entity is not clearly identifiable, it is assumed that its duration is 12 months. The current assets also includes those that are held primarily for the purpose of being traded, those that are expected to be realized within 12 months after the date of the statement of financial position, or it is cash or cash equivalent unless it is restricted from being exchanged or used to settle a liability for at least 12 months after the date of the statement of financial position. If the cash or cash equivalent is restricted for more than 12 months after the date of the statement of financial position, that cash or cash equivalent is classified under non-current asset. The non-current assets, on the other hand, are the assets that do not classify under the current assets, and it also include mga tangible, intangible, and financial assets of a long-term nature. The tangible assets, by the way, refers to the assets that can be touched or felt, like for example, the equipment, the building, so you can touch them. And then the intangible assets are those that has or that have no physical appearance, like a patent, copyright, royalty, like that. And then financial assets of a long-term nature, like for example, investment in bonds. Okay, so we have here specific composition of current and non-current assets. So, kabalo ko nga naglisod mo og sabot sa definition sa current ug non-current assets kaganina. So, let's go down to the specifics. So, you need to memorize kung unsa kaayo ang ibutang under the current assets ug unsa kaayo ang ibutang under the non-current assets. For the current assets, we have cash and cash equivalents, financial assets, trade and other receivables, inventories, and prepaid expenses. So take note lang with the cash and cash equivalents, because if the cash and cash equivalents is restricted for more than 12 months, so that cash and cash equivalents should be classified under non-current assets. But if the problem is silent, that means that cash and cash equivalent is not restricted and therefore it is classified under the current assets. For the non-current assets, we have property, plant, and equipment, long-term investments, intangibles, and other non-current assets. So we will be discussing these items one by one, starting off with the cash and cash equivalents under the current assets. Okay, so we'll start with the word cash first. So the word cash includes money, money substitutes, and current working funds. When we say money, it can be on hand, and we call it cash on hand, and it may also be in bank, and we call it cash in bank. The cash on hand actually refers to the bills and coins that are not yet deposited in the bank and are still inside the premises of the business. Like, for example, the bills and coins inside the cash drawer, the bills and coins inside the cash register, the bills and coins inside the vault. So wherever these bills and coins are, as long as they are still inside the premises of the business, then they are known as cash on hand. Now, the cash in bank, so the term speaks for itself. Cash in bank. So this refers to cash that are deposited in the bank. So these are the bills and coins that are deposited in the bank. Cash also includes money substitutes, and money substitutes are cash items in the form of customers' checks, bank drafts, money orders, managers' checks, cashier's checks, or traveler's checks, provided that these items are acceptable for immediate credit or for immediate encashment. And then we have current working funds. So cash also includes current working funds. So these are funds that are set aside to meet current needs like petty cash fund, interest fund, dividend fund, and payroll fund. So these are called as working funds because these funds are maintained for the current operation of the business. So gamitonon kay ni sila nga funds sa day-to-day activities sa business. That's why they are classified under cash and cash equivalents. Now let's move on to cash equivalents. The cash equivalents are short-term liquid investments that are readily convertible to known amount of cash and which are subject to an insignificant risk of changes in value. An investment qualifies as a cash equivalent only when it has a short maturity of, take note of this one, 3 months or less from the date of acquisition. So the following are examples of cash equivalents. So you need to memorize this one. We have 3-month time deposit, 3-month money market placement, a 3-month BSP treasury bill, 5-year treasury bill acquired 3 months before maturity date, and then we have preference shares acquired within 3 months of their maturity and with a specified redemption date. Again, I would like to emphasize lang that an investment qualifies as cash equivalent only if it has a short maturity, which is 3 months or less from the date of its acquisition. That's why here in the examples, kung nakabantay mo, ihang maturity is always 3 months. So we have 3-month time deposit, 3-month money market placement, 3-month BSP treasury bill. Although naiuban nga ihang maturity is more than 3 months, but take note that it is acquired 3 months or less from the date of its acquisition. That's why we have 5-year T-bill acquired 3 months before maturity date. So it's always been 3 months or less from the maturity date in order to classify as cash equivalent. So if the maturity of the investment is more than 3 months but within 1 year, that investment is classified as a short-term financial asset or short-term investment, and that will be presented separately under the current assets. And then if the maturity term of the investment is more than 1 year, so that investment is classified under non-current or long-term investment, and that will be presented separately under the non-current assets. Now, what if there is a cash in foreign currency? So in that case, the amount of cash in foreign currency is valued at the current exchange rate, and it will be shown either under the current asset section or the non-current asset section. If the foreign currency deposit is not restricted as to its use, then that will be presented under the current asset section under the account title cash and cash equivalents. But if the foreign currency deposit is restricted, then it will be presented under the non-current asset section. So next we have bank overdraft. So bank overdraft occurs when there is an overissuance of checks against the amount of deposits in the bank. Let's say, for example, ABC company maintains a demand deposit account or checking account with account balance of 200,000 pesos with DEF Bank. And then ABC company has this policy that all of its expenses will going to be paid through checks. So, kinahanglan mag-issue si ABC company og checks every time nga na ay payment nga mahitabo. So, what happened is that ABC company nag-issue og checks, and then later at the end of the month it was found out that the check issuances amounted to 250,000 pesos. So in this case, there is a bank overdraft because the total amount of checks issued is 250,000, and then the available account balance is only 200,000. So there is a bank overdraft of 50,000 pesos. So this bank overdraft is shown as part of current liability. So therefore, the bank overdraft in the example amounting to 50,000 pesos will be presented under the current liability section. And then we also have here, bank overdraft should not be offset against the bank accounts with debit balance unless the amount involved is immaterial or the two or several bank accounts are maintained in the same bank and one of the accounts has a credit balance. So in general, ang bank overdraft dili na siya pwede i-offset against the other bank accounts with available balances. Like for example, si ABC company nasa siya gi-maintain nga bank account with XYZ Bank and it has an available balance amounting to 100,000 pesos. So kung kanina sa atong example na natay bank overdraft si ABC company nga 50,000 sa DEF Bank. So, dili pwede less ang 50,000 overdraft sa DEF Bank against the cash balance or the available balance nga 100,000 sa XYZ company. So, di pwede nga 100,000 less 50,000 overdraft and then you will report 50,000 pesos as net cash in bank. So it should be separately presented in the statement of financial position. So the bank overdraft of 50,000 pesos will be presented under the current liability, and then the cash in bank balance with XYZ company, XYZ Bank amounting to 100,000 pesos, it should be presented separately also under the current assets. However, there is an exception to that rule, and that is if the amount involved is immaterial or the two or several bank accounts are maintained in the same bank and one of the accounts has a credit balance. Now let's move on to post-dated checks. So, post-dated check is a check that is already drawn, recorded, and already given to the payee, but it is dated subsequent to the end of the reporting period. Like for example, the end of the accounting period is December 31, 2021 and the date of the check is March let's say 27, 2022. So this is an example of a post-dated check. So you can only encash this check on March 27, 2022. And with that, the post-dated check is not yet considered as cash. So, di pa siya makonsider nga cash in the sense that maghulat pa ka og March 27, 2022 before nimo magamit nga check or before to nimo ma-encash. So, if ever the company receives a post-dated check from a customer in payment of the goods or services, so that post-dated check is not yet considered as cash payment. Instead, it is still treated or it is still considered as a trade receivable. On the part of the customer that issued the post-dated check, there must be a reversing entry that must be done in its book of accounts. So normally, when the customer issued a check, so that is already considered as payment on the part of the customer. So sa iyahang books of accounts, he will record this payment as a debit to accounts payable and then credit to cash in bank. So in this entry, the obligation of the customer or the liability of the customer is already settled or canceled, which is not correct. 'Di ba? Because the issued check is a post-dated check. So therefore, in effect, there is no payment yet since you need to wait for that time for that date to arrive. So, mao nang si customer, kinahanglan siya mag-prepare og reversing entries at the end of the accounting period. And the reversing entry will include a debit to cash in bank. So, i-debit na to pagbalik ang cash in bank because ang check na na-issued is a post-dated check and therefore wala pa makuha ang cash in bank balance sa customer. So, atong ibalik by debiting the cash in bank. And then the credit entry will be the liability account, which in our example is accounts payable. So, kinahanglan nato i-restore pagbalik ang accounts payable because as I said earlier, the check issued is a post-dated one. So, therefore, in effect, there is no payment made. And then let's move on to compensating balance. So, compensating balance refers to the amount that represents the required balance to be maintained by the borrower with the bank in connection with a loan. If the compensating balance is not restricted as to withdrawal, so this compensating balance is going to be presented as part of the cash and cash equivalents. Again, and that if the compensating balance is not restricted as to withdrawal. But if the compensating balance is restricted and the related loan is short-term, so therefore the compensating balance is separately presented under the current assets. And if the compensating balance is restricted and then the related loan is long-term, so therefore the compensating balance is separately presented under the non-current assets. Current assets also includes financial assets. And under past 32, financial assets is defined as any asset that is in the form of letter A, we have cash. So from the word itself, financial assets. So when say financial, it has something to do with cash. Letter B, financial assets could also be in the form of equity instrument of another entity. Okay, let me give you first the definition of financial instrument. So, financial instrument is any contract that give rise to both financial asset to an entity and financial liability or equity instrument to another entity. So this means that there is a contract involved in financial instrument. So naay kontrata and because of that contract, ang usa ka business entity makadawat siya og financial asset while the other entity ang ihang madawat is either financial liability or equity instrument. So that's why here it says that financial assets could also be in the form of equity instrument of another entity. Kay kung usa ka business entity nakadawat og financial asset, ang other entity could receive either equity instrument and that is item B and financial liability. So financial liability will be discussed in item D. Now let's move on to item C, and it says that a financial asset could also be a contractual right to receive cash or other financial assets from another entity. So, buot pasabot ini na kay madawat nga eventually mahimo siya nga cash. So, for example, kung na kay savings deposit sa bangko. So, ikaw gang bank na mo'y contract. And ikaw as the depositor, you have the contractual right to receive cash every time or inig mag-withdraw ka. However, kung ang imong deposit is gold, so that gold is not considered as a financial asset because dili man to siya cash. Okay? And then aside from your cash deposits in the bank, napilay examples of financial assets. So, 'di ba, financial assets include contractual right to receive cash. So that means even though dili pa siya cash right now, but later on mahimo siya nga cash. For example, accounts receivable, notes receivable, loans receivable, bonds receivable, and other receivables. Because these receivables, inig makolekta ni nimo, what you receive is cash. Okay, so let's proceed. Financial assets also includes contractual right to exchange financial instrument with another entity and their conditions that are potentially favorable to the entity. So the keyword here is exchange. So na-exchange na nahitabo. And since we're in the asset side, so ang exchange to us is favorable. Now, another question, is this considered as financial asset? Matawag mo nato ni siyang financial asset. Yes, it's a financial asset. Tungod kay naa kay kontrata with them. And that contract is all about the share option. So you have the option to buy the shares at the price lower than its market value. So favorable siya, and on the other hand, it's an equity instrument. The financial assets are broadly classified into financial assets at fair value and financial assets at amortized cost. So let's discuss first the financial assets at fair value. Okay, so we'll have first the definition of fair value. So what is fair value? Kindly take note this one. Fair value is the price or the amount paid for the asset in the transaction between participants in an open market. So as we all know, there are two parties involved in a sale transaction. So naidwa ka parties involved sa sale, and these are the buyer and the seller. So dapat kini si buyer o kini si seller dapat voluntary ni sila nga misulod sa contract of sale, meaning to say wala sila pugsa, and dapat knowledgeable sila about the transaction. And then when it comes to the price, dapat fair ang price sa asset, kanang gitawag nato nga tamang presyo, and then walay gi agrabyado. Now, what are those financial assets at fair value? So we have letter A, those held for trading. So when say trading, it involves buying and selling. So you buy financial assets today because you feel like barato siya, and then you're going to hold it for quite a while, and then if you feel like ni mahal na ang iyang fair value, pwede nimo to siya ibaligya to gain profit because of the changes in fair value. And then eventually pwede sad nimo siyang paliton og balik inigit barato na sad ang iyang fair value, and then if mahal na sad ang fair value niya, imo na siyang ibaligya na sad para mag-gain kag profit. So that basically involves buying and selling of financial assets. Financial assets at fair value also include letter B, those whose designations at initial recognition are at fair value through profit or loss. So this is applicable only to debt securities like bonds. This is not applicable to equity securities or katong mga shares or stocks. So debt securities can be measured in a number of ways. Aside from measuring it at fair value, you can measure it at amortized cost and FVOCI, fair value through other comprehensive income. But in this case, your designation is at fair value. So if you're going to designate, or if you're going to choose this any of that measurement, that is irrevocable, meaning to say dili na nimo na siya pwede usbon pang, like at first you're using fair value, and then later on imo siyang i-change into amortized cost. So if you pick the fair value, then you have to measure it at fair value permanently. Okay, and then let's have letter C. Financial assets at fair value also include those investment in quoted equity instruments. So take note with the term equity instruments. So this only applies to shares, mga stocks. Okay, and then we have diba, quoted equity instruments. So what exactly are this? An example for this one are those companies that are publicly listed. Katong mga companies nga listed sa PSE or sa Philippine Stock Exchange. So the shares of these companies are quoted. Meaning to say, even though di pa nimo siya ibaligya, but the price of these shares are always given. Nag-price nga ginahatag. And because of that, these shares are valued at fair value. And here's now the bottom line. All financial assets at fair value are classified under current assets. So, tanang financial assets at fair value should be classified under current assets. Let us now move on to the second category of financial assets, and that is financial assets at amortized cost. So, financial assets shall be valued at amortized cost provided the following requirements are satisfied. So, these two requirements kinahanglan masatisfy sa ni sila before nato maklasify ang usa ka financial assets at amortized cost. So, we have letter A. It is intended to hold and collect contractual cash flows on specified date. So, ang imo yung purpose sa pag-acquire ng financial assets is to collect cash. No? We have here, collect contractual cash flows on specified date. So, in short, ang imuhag yung purpose is to collect cash. Now, let's move on to the second requirement, and that is letter B. The contractual cash is solely for payment of principal and interest on the principal amount outstanding. So, ang imuhang i-collect is the payment for principal and interest. That is why financial assets at amortized cost is not applicable for equity instruments or mga shares. Kaya unang-una ang shares, dili ka magbayad ng interest ana, and then wala po na specified date kung kanus ani mo bayaran siya. So, again, this is only applicable to debt securities. So, a good example of financial asset at amortized cost is the bonds, kanang investment in bonds. However, I'd like to clarify lang ang bonds or the investment in bonds could also be measured at fair value through profit or loss kung pilion nimo itong designation. Here's now the bottom line for financial assets at amortized cost. So, all financial assets at amortized cost are classified as non-current assets as part of long-term investment line item. So, katong sa financial assets at fair value, they are classified under current assets, while the financial assets at amortized cost, they are classified under non-current assets as part of long-term investment line item.